Girl math says if you return one item and buy another with the store credit, the new thing is free. Girl math says a $200 dress is basically $40 if you wear it 5 times. Girl math says paying in 4 installments of $12.50 doesn't count as spending $50. That last one isn't a joke anymore. That's the actual mechanism behind buy now, pay later, a payment method that now has roughly 91.5 million users in the US alone, with a 41% late payment rate. And grocery purchases financed this way have nearly doubled in a single year, from 14% of users to 25%. So here's the direct answer, the one nobody's given you yet. Girl math isn't a personality quirk. It's a textbook case of mental accounting, a cognitive bias so well documented that economist Richard Thaler won a Nobel Prize for identifying it. And the exact same broken logic that makes a return feel like free money is the logic that 4 installment checkout buttons are built on purpose. This isn't a video making fun of you. It's the video explaining why your brain does this, why it's not about intelligence, and where the joke stops being a joke and starts being a bill you owe on food you already ate. By the end of this, you'll know exactly what mental accounting is, why under $5 doesn't count is quietly the most expensive belief in your budget, and how to keep the parts of this that are genuinely harmless while shutting down the one part that isn't. Let's start with the thing everyone's laughing at and take it seriously and finally get girl math explained properly. The joke that's not a joke. What girl math actually is. Let's define this properly because most people talking about girl math right now have never actually written down what it is. They've just reacted to it. Girl math as a trend is a set of informal rules for reclassifying spending so it feels smaller or free. The core examples repeat across almost every version of the trend. If you return something and use the credit toward a new purchase, the new purchase is free. If you pay with cash, it doesn't count because the money already left your account emotionally. If something is under a certain price, $5, $10, it's a rounding error, not a purchase. If you buy something and it goes on sale a week later, you've made money. And if you buy now and pay later, the money you'll owe in 6 weeks doesn't feel like money you have right now. None of that is stupid. That's the part worth saying clearly before we go one sentence further, because the entire reason this trend has become a punchline is that people mistake it for a female-specific flaw in logic. It isn't. It's a set of shortcuts your brain uses to make dozens of small financial decisions a day without doing full arithmetic every single time. Every human brain does some version of this. The reason it's coded as girl math is cultural. It went viral inside a specific community, on a specific platform, using a specific tone of self-aware humor. The mechanism underneath it has nothing to do with gender. Here's what makes this trend genuinely interesting instead of just annoying. It's one of the only viral finance trends in the last several years that accidentally reverse-engineered a real, peer-reviewed psychological concept without anyone naming it. The people making these jokes stumbled into describing, with total accuracy, a bias economists have studied since the 1980s. They just didn't call it what it is. They called it a bit. And that's the gap this video is going to close. Not girl math is dumb. Stop doing it. That take already exists 1,000 times over. It's lazy, and it doesn't help anyone. And not here's a budgeting app, which ignores the actual question, which is, why does my brain accept this logic in the first place? Because here's the uncomfortable part. The instinct behind, it's free because I return something else, is the exact same instinct that makes a 4-payment checkout button feel harmless when it's actually a loan. Same wiring. Same blind spot. One version costs you nothing because it's a joke between friends about a candle. The other version is currently generating late payments for roughly 4 in 10 users of a payment method that didn't exist 15 years ago. That's not a coincidence, and it's not an accident. It's the same cognitive bias, showing up at 2 completely different scales. One is funny. One is a checkout button quietly running the numbers on you. The bias has a name. It's called mental accounting. And once you understand how it actually works, not the meme version, the real mechanism, you'll start noticing it everywhere your money moves, including in places that were never trying to be funny at all. That's next. Meet mental accounting, the 50-year-old Nobel-winning theory hiding inside your TikTok jokes. In 1985, an economist named Richard Thaler published a paper in a marketing journal Not even an economics journal, which mattered because economists weren't ready to take this seriously yet. The paper was Thaler's third most cited work with over 6,000 citations, and it went after one of the most basic assumptions in all of economics: fungibility. The idea that money carries no labels, and the way a person uses it shouldn't be affected by where it came from or what it was originally intended for. Thaler's argument was simple, and it was heresy at the time. That's not how real people actually think. He proposed that individuals and households mentally partition their money into separate, non-fungible categories based on subjective factors like source, intended use, or timing, and that this partitioning systematically leads people to make decisions that deviate from what pure rational math would predict. He called it mental accounting, a model of consumer behavior describing the process by which people code, categorize, and evaluate economic outcomes. This wasn't a fringe idea that stayed in academic journals. In 2017, Thaler was awarded the Nobel Memorial Prize in Economic Sciences for his contributions to behavioral economics, and mental accounting was one of the central pillars of that body of work. His contributions built on earlier Nobel-winning work by Herbert Simon and Daniel Kahneman, essentially finishing a decades-long argument that human beings don't run on a calculator. They run on categories, feelings, and labels. Here's the classic example economists use to prove the point, and it's worth walking through slowly because once you see it, you can't unsee it. Imagine you buy a $20 movie ticket and on your way into the theater, you realize you lost it. Do you buy a second one? Most people say no. That feels like paying $40 for one movie. Now imagine a different version. You haven't bought the ticket yet, and on your way to the box office, you realize you've lost a $20 bill from your wallet. Do you still buy the ticket? Most people say yes. This is the theater ticket experiment, a standard technique used to demonstrate mental accounting, and mathematically, both scenarios are identical. You're out $20 either way, and the choice in front of you is the same. Spend another $20 to see the movie or don't. But your brain doesn't file it that way. It files money for the movie as one account and cash in general as another, and losing money from one account feels completely different from losing money from the other, even when the number is exactly the same. That's mental accounting in a single sentence. Identical dollars, treated as different dollars because of the label attached to them. Now here's where this gets uncomfortable for anyone who's ever laughed at a girl math video, including the people making them. Every single core example of the trend is a live demonstration of a documented mental accounting principle. It's free if I return something else is what researchers call segregation of gains and losses. Thaler's framework explains how people mentally bundle outcomes and how a loss in one account can be offset by a gain in a different account even when no actual net gain occurred. You didn't get anything for free. You moved money between two jars in your head and called the second jar empty. Cash doesn't count the same as card is a version of what Thaler and later researchers described as payment depreciation, the behavioral effect of temporally separating the moment you pay from the moment you consume, first studied formally by Gorville and Soman. The further the pain of paying is separated from the purchase itself, the less that payment registers as a real loss. Under $5 doesn't count is a threshold-based version of transaction utility, the idea, central to Thaler's model, that people group expenditures into separate categories, each with its own budget and its own reference point, which limits how fungible money feels between those categories. A small purchase gets filed into a mental category so minor it doesn't touch the real spending ledger at all, regardless of how many times it repeats. None of this is a coincidence, and none of it is unique to any one demographic. Thaler argued mental accounts exist because they help boundedly rational people simplify financial decision-making, meaning this isn't a flaw in judgment, it's a feature your brain installed on purpose, because doing full rational math on every $4 purchase, all day, every day, would be exhausting. The system exists because it's useful. The problem isn't that the system exists. The problem is what happens when something outside your own head learns exactly how the system works and builds a product specifically to exploit it. That's the real reason this trend deserves 15 minutes of serious attention instead of a 15-second joke. You don't have one mental account. You have several running at once, and the entire next part of this video is about proving that by opening every single one of those jars and showing you exactly what's living inside them and how much it's actually costing you to keep them separate. Your brain has multiple wallets, and that's the whole problem? Let's actually open these jars, because mental accounting as a phrase is easy to nod along to and easy to forget 5 minutes later. What makes it real is watching it happen with actual numbers, in a real study, done on real people who had no idea they were being tested. Here's one of the cleanest examples on record. Researchers gave a group of people $25 and split them into two framings. One group was told it was a bonus. The other was told it was a rebate. Same amount of money, same people, same moment in time. The only thing that changed was the word attached to it. The group told it was a bonus went on to spend an average of $11.16 of it. The group told it was a rebate spent an average of just $2.43. That's not a small gap. That's nearly 5 times more spending, triggered by nothing except a label. The money was identical. The people were, statistically, identical. The only variable was which mental jar the $25 got dropped into. Extra money I'm allowed to enjoy versus money that was already mine, just coming back to me. One framing gave people permission to spend. The other didn't. This is the pattern researchers keep finding whenever they study windfalls, specifically unexpected money, as opposed to earned income. Unearned money tends to get treated as inherently less real than earned money, even when the spending power is exactly the same dollar for dollar. It's easier to justify spending money you feel you didn't have to work for. Tax refunds, casino winnings, a surprise bonus, store credit from a return, all of it lands in a jar your brain has quietly labeled, not really mine yet, which makes it dramatically easier to release. Now hold that up against the "it's free because I returned something" logic from girl math, because this is the exact mechanism, caught in the act. Store credit from a return doesn't get filed as cash I currently have. It gets filed into its own jar, money that's not really spending, and anything you pull from that jar feels weightless in a way that identical cash from your checking account never would. You didn't get anything free. You moved $60 out of one account and used it to justify $60, leaving a different one. The net change to your actual wealth is exactly the same as if you'd never returned anything and just bought the new item outright. But it doesn't feel the same because it never touched the jar your brain guards the closest. Thaler's original research described this same principle at the household level, using everyday categories. People mentally sort spending into buckets like housing, food, and clothing, each with its own internal budget and its own separate reference point, which is exactly why $40 disappearing from the clothes jar feels routine, while $40 disappearing from the rent jar feels like an emergency, even though your bank account only sees one number. This is the part worth sitting with. Your bank account has no jars. It has one number. Every dollar in it is exactly as real and exactly as spendable as every other dollar. The jars only exist in your head, but the spending decisions you make based on those imaginary jars are completely real, and they show up as completely real numbers at the end of the month. So here's where this is heading. If a bonus dressed in the right label can get someone to spend nearly 5 times more of it than the same money dressed differently, then somewhere out there, someone with a financial incentive already knows this. Someone has already asked the obvious next question. What if you could design a purchase that automatically drops itself into the "doesn't really count" jar every single time, on purpose, by design, at checkout? You don't have to imagine that. It already exists, and we're going to open it up specifically, the return credit jar first, in the next chapter, using one exact case study most people live through and never examine. It's free if I return something else. Deconstructing the first logic trap. Let's build this out as one continuous case study, start to finish, because the fastest way to see a logic trap clearly is to walk through it in real time instead of talking about it in the abstract. You order 2 sweaters online, same style, 2 different sizes, because you're not sure which one fits. This is common enough to have a name in the retail industry. It's called bracketing, and 63% of consumers now openly admit to doing it, ordering multiple sizes or variations of the same item specifically to send back whatever doesn't work. It's built into how people shop online now, largely because returns have become frictionless by design. One sweater fits, one doesn't. The one that doesn't goes back, and a $60 credit lands in your account with that retailer. A week later, you see a dress you like for $60. Girl math says, that dress is free. You didn't spend anything new, You just used money that was already extra. Here's the arithmetic. Nobody runs at the moment it matters. You originally spent $120 on 2 sweaters. You now own 1 sweater and 1 dress. Total spent, $120. Total kept, 2 items. If you'd walked into the store and just bought the sweater you wanted and the dress you wanted from the start, you'd have spent $120 for the exact same 2 items. There is no version of this transaction where anything was free. The free dress feeling is entirely a trick of sequencing. The $60 got returned before the dress got purchased, so your brain never had to watch $60 leave your account and $60 enter it again in the same glance. It just saw a credit appear, and a credit, to your brain, doesn't feel like your money. This is the segregation Thaler described back in Chapter 2, happening in real time, in a scenario nearly everyone reading this has lived through personally. The return credit gets coded as a gain. The new purchase gets coded against that gain instead of against your actual balance. 2 events that are mathematically one continuous transaction get mentally split into 2 separate stories, a happy one and an invisible one, and only the happy one gets remembered. Now here's why this particular trap is bigger than any individual purchase. Retailers know this behavior exists at scale, with real numbers behind it. In 2025, U.S. retail returns totaled $849.9 billion, representing 15.8% of all retail sales. Online return rates now average close to 20%, roughly 2 to 3 times higher than in physical stores, largely because you can't try something on before you buy it. Apparel specifically returns at 20% to 30%, with some fashion categories reaching as high as 50%, and sizing or fit issues alone account for 45% of all returns industry-wide. Retailers aren't fighting this pattern. Many are actively designing around it because the data on customer behavior tells them something counterintuitive. Shoppers who return the most also tend to spend the most and stay the most loyal because an easy return policy is exactly what gives people the confidence to buy freely in the first place. A frictionless return isn't just a convenience they're offering you. It's a mechanism that keeps the "it's basically free" feeling alive, purchase after purchase, because every return resets your mental ledger back to 0 instead of forcing you to look at your actual running total. That's the trap in full. It's not that returning things is bad or that store credit is a scam. It's that the credit itself becomes a new, separate mental jar, Chapter 3's jar, filled with money that no longer feels like spending, and every dollar you spend out of that jar quietly avoids ever being counted as an actual purchase in your head, even though your bank statement counted at the moment it happened. This is one jar. It's the easiest one to see because it involves a physical box going back in the mail. The next one is quieter because it doesn't involve a box at all, just the difference between a piece of plastic and a piece of paper, and why your brain treats the exact same $60 completely differently depending on which one delivered it. The cash versus card illusion. Why money feels fake the moment it's digital. In 2001, 2 MIT business professors, Dražen Prelec and Duncan Simester, ran an experiment that ended up becoming one of the most cited studies in behavioral economics, and once you hear the setup, you'll understand why. They auctioned off real tickets to a Boston Celtics game. Every participant wanted the same tickets. The only difference was this. Half the group was told that if they won the auction, they'd have to pay in cash. The other half was told they'd pay by credit card. Nothing else changed. Same tickets, same room, same people, same game. And the credit card group submitted bids that were, on average, nearly twice as high as the cash group's bids. Read that again because it's easy to skim past how strange it actually is. These weren't different people with different budgets. The exact same population, split randomly, was willing to spend roughly double for an identical item purely based on which object was going to leave their hand at the moment of payment. Prelec and Simester called this the credit card premium, and the researchers who've built on their work since have generally converged on the same explanation. Cash involves an immediate, physical, visible loss. You watch bills leave your hand, and they are simply gone. A card involves no such moment. There is no visible transfer, no reduction in anything you're holding, just a swipe and a receipt. The purchase happens, but the pain that's supposed to accompany a purchase gets separated from it and shows up later, disconnected, buried inside a statement you may not look at for weeks. This is what researchers in the field call the pain of paying, and it's not a metaphor in the loose sense. Brain imaging studies on payment behavior have since shown that different payment methods measurably change how strongly people register a purchase as a loss at all. Cash triggers that loss signal immediately. A card mutes it. A tap or a stored payment method mutes it further still. Now line this up directly against girl math's second core belief. Cash doesn't count the same as card. That instinct isn't imaginary or silly. It's an accurate, felt description of a documented psychological effect, one strong enough to roughly double what people are willing to pay for the exact same object in a controlled study. The problem was never that the feeling is fake. The problem is what happens once you understand that the feeling is real, predictable, and measurable, because that means it can be engineered. Every step down that friction ladder isn't an accident of technology improving. It's a design choice, and each choice has consistently pushed spending in one direction. Soman's research comparing credit cards to checks found the same pattern in a slightly different form. Paying by card produced less psychological resistance than paying by check, even though a check is also just paper, because a check still requires you to write out the amount by hand, in your own handwriting, watching the number form as you go. Every reduction in that friction, check to card, card to tap, tap to stored and forgotten, has been shown to increase what people are willing to spend and how easily they spend it. Here's what this means for you directly, stripped of the lab study framing. The less physically real a payment feels at the moment you make it, the less your brain logs it as a real loss, regardless of what it actually costs you. That's not a character flaw. It's a documented, replicated, nearly universal human response to how differently we experience visible loss versus invisible loss. You're not weak for feeling this. You're responding exactly the way the research predicts almost everyone will respond. But there's one more variable in that friction ladder we haven't touched yet, and it's the one doing the most damage right now at scale to more people than any of the examples so far. It's not just about the payment method feeling invisible. It's about the amount itself feeling too small to count, no matter how many times it repeats. And that's a completely different kind of blind spot, with its own body of research and its own price tag, which is exactly where we're going next. Under $5 doesn't count. The threshold bias that's draining you daily. Of all the jars we've opened so far, this one is the most expensive, and it's the most expensive precisely because it never feels like it's costing you anything at all. Here's the belief, stated plainly. If something costs under $5, it doesn't really count as spending. It's a rounding error. A coffee, an app charge, a small delivery fee, $1 more on a subscription you forgot you had. None of it registers because your brain has a threshold below which a purchase simply doesn't get logged as real money leaving your account. Researchers have put an actual number on what that threshold habit costs, and the number is bigger than almost anyone expects. According to C+R Research's widely cited study on subscription spending, the average American estimates they spend around $86 a month on subscriptions. When the same people are asked to go category by category and actually itemize it, the real total comes out to $219 a month. That's a gap of $133 every single month between what people believe they're spending and what they're actually spending, which compounds to roughly $1,596 a year, disappearing entirely inside charges too small to register individually. That gap isn't a failure of math. Nobody sat down and got the arithmetic wrong. It's a failure of visibility, and it happens for exactly the reason mental accounting predicts. Each individual charge is small enough to fall below the threshold your brain uses to decide something is worth tracking. A $219 total would absolutely register as real spending if it arrived as one number once. Spread across a dozen or more charges of $5, $8, $12, auto-billed, staggered across different dates, buried in different apps and different cards. It never adds up in your head, even though it adds up perfectly well on your statement. This is threshold bias, and it's a direct extension of the mental accounting we've been tracing this whole video. Thaler's framework describes how people group spending into categories with their own internal budgets, and small, individually insignificant amounts frequently get filed into a category that's never checked at all, a kind of financial blind spot your brain builds on purpose, specifically because checking every $5 charge every day would be exhausting. It's a shortcut. But shortcuts have blind spots, and this is one companies have learned to build products around. Consider what the data shows about how these charges actually behave once they're set up. Research on subscription habits finds that 72% of consumers keep every subscription on autopay, and 42% admit they've forgotten about a subscription entirely while it kept charging them. That's not a coincidence of bad memory. Autopay is the exact mechanism that converts a $133 a month blind spot into a permanent one, because the entire point of autopay, from the business's perspective, is to remove the one moment where you'd actually notice the charge and decide whether you still wanted it. This is the same under $5 doesn't count instinct from girl math, but running on a subscription cycle instead of a single purchase. The logic is identical. An amount small enough to feel negligible, repeated often enough and invisibly enough that it never crosses into the category of spending I pay attention to. A single $6.99 app charge genuinely is negligible. 20 of them, quietly auto-renewing every month across a year, is $1,600, real money, spent on things you may not even remember signing up for, none of which ever felt like a decision because none of it ever felt big enough to require one. Here's the pattern that should be starting to feel familiar by now, because it's the same pattern in every jar we've opened. It was never really about the size of any one transaction, the free return, the tap of a card, the $6.99 charge. It was always about whether the transaction crossed a threshold your brain uses to decide something is worth counting. Below that threshold, money can leave your account completely unopposed, again and again for years. And that raises the question this entire video has been building toward. If a threshold this small, this quiet, can hide over $1,000 a year without anyone noticing, what happens when an entire payment industry is deliberately built to keep every single transaction just underneath that same threshold on purpose at checkout every time? That's not a hypothetical anymore. That's Chapter 9. But before we get there, we need to deal with something else first. The identity defense that's been sitting underneath this entire video since the opening minute, because you can't fix a blind spot you're busy defending. Why smart women fall for this? It's not about IQ, it's about design. Let's deal with the thing sitting underneath every previous chapter, because if we don't name it directly, it'll quietly undermine everything else in this video. Somewhere in the last 20 minutes, a part of you may have thought, okay, but I'm not dumb. I know exactly what I'm doing when I say the dress is basically free. That reaction is completely reasonable, and here's the research that actually validates it, instead of dismissing it. Psychologist Keith Stanovich has spent decades studying the relationship between raw intelligence and susceptibility to cognitive bias, and his findings consistently point to the same uncomfortable conclusion. For a specific category of biases, being smarter doesn't protect you. Stanovich and his colleague Richard West found that biases like my-side bias and anchoring effects are fairly independent of intelligence, meaning measured cognitive ability essentially has no relationship to how strongly a person falls for them. It gets stranger than no relationship, and this is the part worth sitting with. Stanovich, along with researchers West and Meserve, specifically studied something called the bias blind spot, the tendency to believe bias thinking is far more common in other people than in yourself. Their research found that cognitive ability provided no inoculation at all from this blind spot. And in some of their data, measures of cognitive sophistication were actually positively correlated with the size of a person's bias blind spot, meaning the more cognitively sophisticated someone was, the more confident they were that bias was something that happened to other people. Read that finding again because it directly answers the identity fear sitting underneath the entire girl math conversation. It's not that intelligent people are somehow more vulnerable to mental accounting. It's that intelligence gives no protection either way, and the confidence that comes with being generally sharp can, ironically, make it harder to notice when this particular blind spot is operating on you personally, because your brain has plenty of evidence, from plenty of other domains, that you're a good thinker. That evidence just doesn't transfer to this specific bias, the same way being an excellent driver doesn't make you immune to optical illusions. This is why girl math is just a joke. I know what I'm doing, and I'm actually falling for a documented cognitive bias are not contradictory statements. Both can be true at once. You can be fully capable of correct arithmetic, genuinely able to calculate on request that $120 is $120 regardless of how it's split across a return and a new purchase, and still have your spending decisions influenced by mental accounting in the moment, because the bias doesn't operate at the level of "can you do the math?" It operates at the level of which mental account the money gets filed into before the math ever gets a chance to run. And this is exactly why gender was never the relevant variable in the first place. The trend went viral inside a specific online community using a specific self-aware comedic voice. That's a cultural and platform detail, not a psychological one. The underlying mechanism, mental accounting, was documented using mixed populations, studied across genders, and has held up as one of the most replicated findings in behavioral economics precisely because it isn't demographic specific. Thaler's original theater ticket experiment, the credit card premium study, the bonus versus rebate framing research, none of these findings were confined to one gender. They show up in trading floors, in corporate budgeting decisions, in retirement account behavior, in how executives spend company windfalls. Mental accounting is a feature of the human decision-making architecture. Full stop. So here's the honest version of what's actually happening, without the joke and without the judgment. This isn't a flaw in your intelligence. It's a universal feature of how every human brain manages the enormous cognitive load of constant financial decision-making, and no amount of being good at math protects anyone from it because it was never a math problem. It's a filing problem, a financial logic fallacy your brain runs by default, not a personal one, which account a piece of money gets dropped into before your excellent brain ever gets asked to evaluate it. Which means the actual question worth asking isn't, am I smart enough to avoid this? You already are, and it still won't help because that's not how this bias works. The real question is what this filing error actually costs, in hard numbers, once you stop treating it as a joke and start treating it as the recurring, measurable expense it actually is. That's the next chapter, and it's the one where all 6 jars we've opened get added up into a single total for the first time. The real cost, what girl math is quietly doing to your bank account. The math, finally. We've opened 4 separate jars so far, and each one came with real research behind it. Now, let's do the thing nobody making girl math content has actually done. Put them next to each other and add them up, using nothing but the numbers already on the table. This isn't a single new study claiming to have measured the cost of girl math. That study doesn't exist yet because almost nobody has taken the trend seriously enough to fund one. What we can do instead is build an honest composite, using the real research already cited in this video, and apply it to one ordinary year for one ordinary person. Every number going into this comes from a source you've already heard. We're just finally letting them sit in the same room. Subscription blind spot. C+, our research found the average gap between what people think they spend on subscriptions and what they actually spend is $133 a month. Annualized, that's $1,596. Money spent entirely inside the doesn't count threshold from Chapter 6. The return credit trick. This one is harder to annualize precisely because it depends on how often someone shops this way. But consider that the average U.S. consumer returns roughly 13 to 16% of what they buy, and that 63% of shoppers now openly practice bracketing, buying multiple versions of an item specifically to send most of it back. If even a modest portion of a shopper's annual clothing and accessories budget, say $150 to $300 a year, conservatively, gets respent as free store credit rather than being recognized as money that already left the account once, that's another few $100s a year filed as a gain instead of correctly filed as a wash. The cash versus card premium. Prelec and Simastis research found people were willing to bid nearly double when paying by card instead of cash. Nobody doubles their entire budget because of this effect, but even a conservative 10 to 15% uplift in everyday discretionary spending, the extra impulse add-on, the slightly nicer version of the thing, the it's just a tap purchases, adds up fast against a typical household's discretionary spending, which for many households runs well into the thousands annually. Even using conservative, cited assumptions rather than invented ones, a realistic composite for one ordinary year lands somewhere in the range of $2,000 to $3,000, sometimes more, entirely accounted for by money that never felt like spending at the moment it left the account. Not from one big bad decision. Not from one blowout purchase anyone would remember and regret. From dozens of small filing errors, each one individually invisible, each one backed by a real, replicated psychological mechanism. Here's the point of showing you the range instead of pretending there's one magic number. The exact total isn't the important part. The mechanism is. Every single dollar in that composite obeys the same rule we've traced since Chapter 2. Money doesn't feel real the moment its label changes. A return credit doesn't feel like cash. A card tap doesn't feel like a loss. A $6.99 charge doesn't feel like spending. None of these individually would bankrupt anyone. Together, compounding month after month, year after year, they represent a meaningful fraction of what many people would consider a solid financial cushion gone, without a single moment that felt like a decision. And this is exactly where the video has been quietly heading. Because everything you've just watched, the filing trick, the invisible payment effect, the under-threshold blind spot, describes a set of mental shortcuts your brain built for itself, mostly by accident, over a lifetime of small purchases. What happens next in this story is different. What happens next is a payment mechanism that studied this exact set of blind spots and built a checkout button specifically engineered to trigger every single one of them, on purpose, at scale, for profit. That's not a metaphor, and it's not an exaggeration. It's the next 4 chapters. The bridge, how one checkout button weaponized this exact bias. Every jar we've opened so far was one your own brain built, mostly by accident, as a shortcut. This chapter is different, because the jar we're about to open wasn't an accident. It was designed. Look again at that checkout screen. $52 and for interest-free payments of $13 describe the exact same transaction. Mathematically, there is zero difference between them. You are agreeing to hand over $52 either way. But you already know, from everything covered in this video, that your brain does not process those two framings as equivalent. That's not a guess. It's the direct, predictable output of mechanisms this video has already proven, one at a time, using real research. From Chapter 4, you know a payment that arrives broken into pieces gets filed differently than one that arrives as a single total, the same segregation effect that made a return credit feel disconnected from the purchase it funded. From Chapter 5, you know the less physically real a payment feels, the less pain it registers, and $13 typed into an app is about as physically unreal as money gets. From Chapter 6, you know amounts below a certain threshold get filed as negligible, regardless of how many times they repeat, and $13 sits comfortably below almost everyone's mental radar for times over every 6 weeks for as long as the plan runs. By now, Pay Later didn't invent a new psychological trick. It combined 3 that already existed inside your head and pointed all 3 at a single button. And the scale this has reached is no longer a niche story. Around 91.5 million Americans now use BNPL services. The Richmond Fed estimated total U.S. BNPL transaction value at roughly $70 billion in 2025, and global gross merchandise volume through these services hit approximately $560 billion the same year, up nearly 14% from the year before. Here's the number that matters most, though, because it's the one that proves this isn't a harmless convenience. Nearly half of BNPL users, 47%, say they've paid late on one of these loans in the past year, according to LendingTree's 2026 tracker, and that figure has climbed for 2 straight years, up from 41% in 2025 and 34% the year before that. Most BNPL users don't stop at one loan either. 63% have held multiple BNPL loans simultaneously, and a quarter have carried 3 or more at once. And this isn't confined to big-ticket discretionary purchases anymore. Grocery purchases financed through BNPL nearly doubled in a single year, from 14% of users to 25%. That last statistic deserves a moment on its own. Groceries are consumable. You eat them before the final installment is even due. Financing food on a payment plan and then falling behind on that plan means paying a premium in fees, in stress, in credit exposure for something that's already gone. That's not a lifestyle choice going slightly sideways. That's the exact mental accounting failure from Chapter 4 playing out with real debt attached instead of a store credit. So here's the honest version of the bridge this video promised at the very beginning. Girl math and BNPL are not two unrelated topics loosely connected for a video structure. They are the same cognitive vulnerability, observed at 2 different scales. One version shows up as a joke about a free dress. The other shows up as a payment plan for a rotisserie chicken, quietly missed 6 weeks later. The mechanism underneath both is identical: money that's been relabeled just enough to stop registering as real. The difference is that nobody profits from you believing a returned sweater made your dress free. Somebody profits directly and substantially from you believing 4 small payments aren't the same thing as one large one. Whether it's Klarna, Afterpay, or Affirm, the mechanism is identical. That distinction, accidental bias versus engineered bias, is exactly where this video goes next, because understanding that a mechanism exists is different from understanding that it was built, tested, and deployed on purpose. Inside the trap, how buy now, pay later turns mental accounting into real debt. Let's take the checkout button apart completely, piece by piece, because the mechanics matter here. This isn't vague debt is bad messaging. It's a specific structure worth understanding exactly. A standard BNPL loan works like this. You pay 25% of the purchase price immediately, and the remaining 75% splits into a handful of equal installments, typically over about 6 weeks. The Richmond Fed's 2026 economic analysis breaks this down precisely, because the loan principal is really only 3/4 of the sticker price, and because the repayment window is so short, the amount of BNPL debt actually outstanding at any given moment is much smaller than the total transaction volume suggests. That's part of why this form of debt has felt so harmless for so long. At any single moment, snapshot style, it never looks large. It only becomes large in aggregate, across dozens of purchases stacked on top of each other, which is exactly the structure most people never see, because no single provider shows them the total. That's the first structural feature worth naming directly: loan stacking. Because BNPL loans are typically spread across multiple competing providers and historically weren't reported to credit bureaus the way credit cards are, a person can hold several of these loans simultaneously without any single lender, or the person themselves, seeing the full picture. Research shows 63% of BNPL users have held multiple loans at once, and 25% have carried 3 or more simultaneously. Each individual loan can look completely manageable in isolation. The aggregate, sitting invisibly across 4 different apps, often doesn't. This is mental accounting, externalized into the architecture of the product itself. Chapter 3 showed you that your brain naturally sorts money into separate, non-communicating jars. BNPL doesn't just exploit that tendency, it recreates it structurally: 1 loan per app, 1 jar per provider, none of them talking to each other, none of them showing you the combined total unless you go looking for it yourself. The second mechanic worth understanding is what's changing right now in 2026, and it directly undercuts the "this is basically free, it's interest-free" framing the entire product is built on. As of late 2025, FICO's newer scoring models can begin incorporating BNPL payment data into credit scores, meaning the invisibility that made these loans feel consequence-free is actively going away. Missing a payment can now affect your credit the same way a missed credit card payment would, even though most BNPL providers still don't report the positive, on-time payments that would help your score. You're increasingly exposed to the downside of this debt without the upside that traditional credit offers in return. And the third mechanic is the one that connects directly back to Chapter 5's research on payment friction. A researcher at the Federal Reserve studying this exact issue put it simply: a shopper who'd normally spend $20 on 1 shirt can instead spend $20 spread across several weeks for 3 shirts, because BNPL doesn't just make payment feel smaller, it demonstrably leads to larger total purchases and lower cart abandonment. That's not a side effect. Multiple industry analyses confirm this is precisely why retailers adopted BNPL as a checkout option in the first place. It doesn't just make existing purchases feel easier, it measurably increases how much people buy per transaction. Put the 3 mechanics together and you get the full trap, not as an accusation but as an accurate technical description: a payment structure that hides the true scope of your debt through provider fragmentation, exposes you to real credit consequences without the corresponding credit benefits, and is specifically associated with larger total spending than you would have made otherwise, all while feeling, at the moment of checkout, like the responsible, budget-conscious choice. This is the same, "it's basically free" instinct from the very first minute of this video, engineered into a financial product instead of a joke between friends. And here's the uncomfortable part worth sitting with before the next chapter. None of this happened by accident. Every one of these mechanics was either discovered through or actively validated by the exact same behavioral research this video has been citing all along. Someone read Thaler. Someone read Prelec and Simister. And then someone built a product around what they found. The industry knows exactly what it's doing. Behavioral design meets predatory finance. There's a difference between saying this product happens to exploit a bias and saying this product was built to exploit a bias. The first is a description. The second is an accusation, and accusations need evidence. So let's look at what's actually documented about how digital products, including financial ones, get designed, and let the evidence make the case rather than the tone of voice. Behavioral design isn't a fringe or secret discipline inside tech and fintech companies. It's a standard part of product development, openly taught and openly referenced. One of the most widely used frameworks, developed by researcher B.J. Fogg, explicitly breaks behavior down into three engineerable components: motivation, ability, and triggers, meaning teams are trained to identify what a user wants, reduce the effort required to act on it, and design the exact prompt that fires at the right moment. This isn't a hidden methodology. It's part of standard product design education, applied every day to everything from social media feeds to checkout flows. What separates ordinary persuasive design from what regulators now call dark patterns is intent and effect, interfaces specifically built to subvert or impair a user's autonomy or decision-making, rather than simply make a good product easier to use. And this isn't a fringe academic concern anymore. It's an active enforcement priority. California's privacy law explicitly defines and names dark patterns in its statutory language. The FTC has fined companies hundreds of millions of dollars over deceptive interface design. Epic Games alone paid $520 million to settle charges that Fortnite's purchase flow was built so a single accidental tap could charge a card, with no confirmation screen. The EU's Digital Services Act gives regulators direct enforcement power over manipulative checkout and consent flows. Here's the finding that matters most for this specific video, though, because it directly answers a question you might reasonably ask. Does this only work on people who are somehow more vulnerable or less financially savvy? A recent empirical study published in Behavioral Public Policy tested exactly that, using a real experimental design across a large participant pool. The result: dark patterns were effective across all groups, and the researchers found only weak evidence that susceptibility was meaningfully affected by income, education, or age. In plainer terms, this isn't a trap that only catches people who weren't paying attention. It's engineered to work broadly, on careful people and careless people alike, because it's targeting a shared piece of human cognitive architecture, not a personal failing. Now hold that finding against what's specifically happening in the BNPL industry right now in 2026. Regulators aren't treating this as a settled, harmless product category. The UK's Financial Conduct Authority is introducing mandatory affordability checks for roughly 11 million BNPL users starting this July, checks that didn't previously exist because the product was structured to avoid the scrutiny traditional lending receives. In the US, FICO has begun folding BNPL payment behavior into credit scoring specifically because regulators and researchers identified BNPL as a source of what one Richmond Fed analysis calls phantom debt, obligations that exist, affect real financial lives, but were invisible to the systems meant to track consumer risk. Meanwhile, the largest provider in this space, Klarna, reported $127.9 billion in gross merchandise volume for 2025, up 22% year-over-year, serving 118 million active users across nearly a million merchants, and went public on the New York Stock Exchange in September of that year. This is not a scrappy fintech experiment operating at the margins. It's a mature, publicly traded, multi-billion-dollar business built on a payment structure that regulators on 3 continents are now actively moving to rein in. None of this requires believing in a conspiracy. It requires believing something much more mundane and much better documented: that behavioral design is a real, teachable, widely practiced discipline, that some applications of it cross a line regulators are now actively drawing, and that a payment product generating over $100 billion a year, built around minimizing the felt weight of every transaction, sits squarely inside that conversation. The industry didn't need to conspire. It needed a product team, a behavioral framework already taught in every design program, and a checkout button. The rest followed from incentives that were always going to point in one direction. So here's where this leaves you, and it's the only place this video was ever going to end up. You now know the mechanism. You know it's not about intelligence, it's not gender-specific, and it's not something willpower alone fixes, because it operates beneath the level where willpower gets a vote. The only real question left is what you actually do with a jar system you now know is there, one you can uninstall, but one you can absolutely learn to work with instead of against. Keeping the fun, losing the damage. Here's the direct answer, the one this video promised at midnight. Girl math isn't a joke about being bad at numbers. It's mental accounting, a documented, Nobel-recognized cognitive bias that treats identical dollars as different dollars based on nothing but a label. Your brain didn't fail. It did exactly what brains are built to do: file money into jars to save effort. The failure only happens when something outside your head learns those jars exist and builds a checkout button specifically to slide into them. The shift isn't stop doing girl math. It's simpler than that. Before any purchase that involves a return credit, an installment plan, or a price under your personal radar, ask one question. What would this look like as one number, right now, in cash? Not 4 payments. Not store credit. One number, one moment. That single habit collapses every jar back into the one ledger that was always true. This weekend, do one thing. Open your banking app and pull the last 3 months. Add up every subscription, every BNPL installment, every basically free purchase as one total in real dollars. Don't fix anything yet. Just look at the number honestly, once, the way your brain has been avoiding all along. Because the jar that's costing you the most isn't the one with a funny name. It's the one wearing a checkout button that already knows everything you just learned and was built specifically to profit from it before you did. That's exactly where we're going next. The debt is the visible part. What's actually happening to your credit score right now, quietly, without a single missed payment showing up where you'd expect it? That's the part nobody's saying out loud. Click through because that answer changes what you do this weekend even more than this video just did.